Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. Ramadan Kareem, may Allah accept our du'as inshaAllah. So today's video I want to go over 5 different companies that are in the growth side of things, and we haven't talked about growth for a while, and I do believe there is actually an opportunity for those who are looking for a growth companies to grab some of them undervalued at the moment, because remember the markets are right now still volatile. But obviously once things change and the sentiments change and maybe interest rates come down, these companies will start doing well again. Because remember, these are the type of companies that will not do well when the interest rates are very high. So you might see an opportunity now that you actually like. And what I'm going to do is I'm going to share with you 5 companies that potentially you might want to add to your portfolio. But as always, I'm not a financial advisor. You're going to have to do your own research and find out a bit more information about each one of the companies before you look into investing in them. Now, overall markets has not been bad this week. I mean, I'm just recording this Saturday morning, so the markets are closed, and as you can see for the week, there's a lot of green than actually red, considering we had the Fed coming out and saying, okay, we're going to raise the interest rates by 25 basis points, saying both of them in the UK and the US as well. So yeah, it's not bad at all. I mean, I thought it would probably be a lot worse than it was. I haven't kept much. I haven't been looking around this week because obviously Ramadan. I just want to focus on doing ibadah. But at the same time, yeah, it's not bad at all. Not bad week. So I'm going to go over quickly these 5 companies. But before I do, again, the portfolio is doing okay. So it had a massive drop at some point this week and then it bounced back again. In terms of where we are with the ISA, still got £1,000 left. So next week and then a week after, each week I'll put about £500. And then we will see where we are, inshallah, at the end of the month. But yeah, so the portfolio, not much change. I've basically bought a few more stocks with the £666 that I had recently. So I will share that today on the Discord. So if you want to join us on that, that would be great. Right, let's start with the 5 companies. So first thing we're looking at, these companies are, we're looking for the name of the company, the Morningstar rating, economic rating or MOP rating if you like, the price. We're looking at EPS, we're looking at price to earnings as well. EPS is earnings per share. We're looking for the price to earnings. We're looking for price to earnings to growth PEG ratio, which basically for the tech companies, growth companies, you want to see this, okay? And I'll show you what this means in a second. Price to sales, okay, we're also looking for that just to see valuation side. So if you look at the PES, you look at the PEG ratio as well, price to sales, that should give us an opportunity to know whether these, an idea, if you like, of where these companies are right now in terms of the valuation side of thing. Profit margin, return on equity as usual. Current ratio, we want to see companies with basically that can cover their debt. Otherwise, with interest rates being so high, we don't want companies that can get into debt and so on. Free cash flow, total return next 5 years, and then next year and the next 5 years in the valuation. Okay, I've shared this with you guys before, but here is, you can pause the video to have a look. But we're looking for basically a PEG ratio, so basically under 1. So just that the stock price is currently accounted for unexpected earnings growth. On the other hand, a higher PEG ratio above 1 point to the stock price is necessarily supporting the growth of the forecasted growth basically. Same goes for price to sales. We're looking for between 1 and 2, okay? Less than 1 is actually better, okay? Return on equity, we're looking for 15 to 20%, especially for this type of companies, if you want to take that sort of a risk, okay? And margin of safety, basically profit margin, we're looking about anything above 20 is really great. Anything below 5 is terrible, okay? So that's where we are. Right, let's have a look at the first company. The first one is Booking.com. It has a narrow economic mode. I'm sure you know this company. If you ever booked a holiday, you'll probably come across their website. They own a lot of other websites as well. $2,500 per share right now. EPS is $76 per share. PE is 32, which is very high. But when you look at the PEG ratio of just above 1 and price to sales of just 6, it's actually not bad. So PEG ratio is actually quite, so it seems a little bit cheap right now. Profit margin, we're looking about almost 18%. Return on equity, 82%. Current ratio just is above 1, which is good. $6 billion of free cash flow, 14% return in the last 10 years. Next year, we're looking at about 20% growth and then 31% after that. 16% discounted right now. $3,050 is where it should be right now. Okay, so another $550 more or less, basically upside if you are looking for this company. The next company we're looking at is Adobe. I don't know if you guys have seen it, but Adobe has come out with something called AI art generator. This thing here is really good. Go and play with it if you haven't seen it yet. It's just it's absolutely amazing, and they are building a ground up kind of thing. They're not relying on basically building on other platforms and so on. So yeah, it's really interesting that they came up with this. Everyone's talking about AI now, so I'm glad they're talking about it as well. So it has wide economic mode, $374 per share. Basically, EPS is $10. PE, we're looking about now 37. So it seems very expensive. But when you look at the PEG ratio, it's just above 1.56. So it's not that bad when you look at the PEG ratio. Price to sales, we're looking about 9. So it seems a bit expensive on that side. Profit margin of 26%, return on equity of 34%. Current ratio is above 1. Free cash flow, we're looking at about $3.4 billion, which is great for this type of business. The Figma deal has not gone through yet, so we'll see what happens when that goes through, if it ever goes through. The total return in the last 10 years, we're looking at about 24%. And then next year, they're expecting their earnings to grow about 13%. And then after that, 14% every single year. Right now, it seems fairly valued. $425 per share is where it should be. I'm still underweight when it comes to that company. I'm still basically in the negative, if you like. The next one is NVIDIA. I'm sure you know this company. They basically right now, with the buzzword being AI, and this company being the company that basically provides all the power for AI and so on, I think it's a great company. But is it overvalued, undervalued? Let's have a look. Okay, $267 per share, EPS of $1.74, PE of 153. Is that even true? I wouldn't be surprised. PEG ratio, we're looking at about $3.21, and price to sales of 24. This is expensive, like 31% premium, right? When we look at the profit margins and return on equity, is actually decent. Current ratio is good. Free cash flow of $3.8 billion. Total return, this is probably why people are paying all that money. Okay, total return in the last 10 years, we are looking at 50, let's call it 56%, which is ridiculous. And then next year they're expecting 33% and then 21%. So because of this, even I think on this price, right, I think even if you buy this stock right now, this is already embedded into it. This price has already this embedded into it. It can't be more than that, man. This is too expensive. $200 right now is 260 something. It was basically less than 200 not long ago, by the way. If we see another dip in the market, you might see it below then. Tesla is the next one. It has a narrow economic mode, $190 per share, EPS of $3.62, which is good actually, because this company used to be negative. Right now it has actually EPS. For that reason, it has a PE of 52. Look at that, 52. In fact, I want to check this. I want to double check if this is true. Yeah, according to Yahoo Finance, it's about 113, so it's still over 100. When you look at the price to PEG ratio of 1.64, price to sales of 7.6, it's not cheap, but it's not too expensive either. Profit margin of 15%, return on equity of 31%. Current ratio is above 1, $7.5 billion of free cash flow, 55% return in the last 10 years, and then 40% next year, and 11% each year, 5 years after. Fairly valued right now, $225 per share is where the price should be. And finally, Palo Alto, the cybersecurity company, has a wide economic mode, $191 per share. It has a negative EPS, so PE is not there yet, but when you look at the PEG ratio of just above 1 and price to sales of 9.71, in terms of profit margin, return on equity is almost non-existent until the company becomes profitable. Obviously, current ratio is below 1, so this company might need, but they have $2.6 billion of free cash, which is good if they ever need it. 26% total return in the last 10 years. Next year, we're looking at about 16%, then 30% after that. Fairly valued right now, $200 per share is where the price should be. So there you have it, 5 different companies. All of them seem undervalued apart from NVIDIA. To be honest with you, if you have a portfolio of like dividend paying companies and you're looking for some sort of a growth to supplement with the some of the companies that are the high yielding company that only going to grow 2%, 3%, the dividend ones I'm talking about, right? and you own companies like Adobe or Booking, these two companies actually are really good in terms of not only do they have a positive free cash flow and so on, they have a lot of money in the bank, and they are very innovative companies. So very well now and so on. Booking.com, I don't know. I would have liked if it was had a wide economic moat, because of, obviously, if you think about it, anyone can take over that sort of a business, right? But because they built this brand, it's very difficult to actually compete with them right now, and they buy all the newer websites that come up every few years. So they kind of monopolize that market. So in terms of Sharia compliant, there's absolutely no issues. The business side of it is absolutely fine. In terms of interest-bearing debt, the Booking is the only one that has about 17% interest-bearing debt. But yeah, the rest of it is absolutely fine. So great companies. If you're looking for that growth, kind of stock that you want to add to your portfolio, maybe you might want to do a little bit more research, find out a bit more about the companies. So yeah, there you go. I'm going to stop the video there, but I've got a couple of videos that I'm planning to do in the next few days, just 10 minutes each, inshallah. But yeah, stay tuned for that. If you haven't joined us in the Discord, let's join us there. If you are already there, I'm going to post a couple of things that some of the buys and sells. I'm going to also post about dividends and so on right now. So inshallah, keep up with that. Inshallah, have a wonderful day. Assalamu Alaikum.